How to pay zero tax on $100,000 per year of retirement income? Absolutely. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for more than 5 decades, helping thousands of Americans optimize their assets and minimize tax and empower their authentic wealth. My favorite financial vehicle, without question, is a property-structured, max-funded, indexed universal life. And this episode will explain one of the big reasons why, okay? If you understand how money works, you can become your own banker, and you can experience 10% payouts. $1 million nest egg can generate $100,000 a year of tax-free income into perpetuity. Okay, here's how. Now, folks, when we talk about what is tax-free in the Internal Revenue Code, very few instruments are totally tax-free. But for over a century, property-structured, max-funded, cash value life insurance accumulates your money tax-free. That is explained in Section 72E of the Internal Revenue Code, okay? Section 7702 of the Code explains how you can access that money the sad way, the dumb way, or the smart way without paying tax, okay? Section 101A talks about the sad way, that when you ultimately die, that's why it's the sad way, it blossoms and transfers income tax-free. Now, a property-structured, max-funded, indexed universal life is the only vehicle in the Internal Revenue Code where you're designing it primarily for the living benefits. You're taking the least amount of insurance you can get away with and putting the most money in as fast as the IRS allows, and it turns into a tax-free cash cow. But you have to adhere to 3 tax citations. These are acronyms: TEFRA, DEFRA, and TAMRA, okay? Now, if you're interested, TEFRA means the Tax Equity Fiscal Responsibility Act of 1982. DEFRA is the Deficit Reduction Act of 1984. Those 2 tax citations dictate the minimum amount of insurance that's required based upon your age, your gender, and your health to accommodate the amount of money that you want to accumulate tax-free and to generate tax-free income in what I'm talking about. I'll explain that more in just a moment. It gives parity. It means this: equality. It means that it doesn't matter if you're 20 years old, 60 years old, or 80 years old. The cost of insurance will be the same. Did you hear that? That you can design it so the insurance gets cheaper as you get older. Most insurance agents don't know how to do that. So that the amount of insurance required is less every year older you are and the more unhealthy you are. And if you're totally uninsurable, it's the owner of the insurance contract that gets all the tax-free income and tax-free accumulation. So you can own these on your spouse or your children. Hello? Banks own these on their stockholders. It's the owner who gets all the tax-free income, okay? That's TEFRA and DEFRA. TAMRA says you have to spread it out when you're funding it. You can't fund it in one fell swoop like you could back when they were first created in 1980. TAMRA is the Technical and Miscellaneous Revenue Act of 1988. And so after 1988, you could no longer put in a whole lump sum, let's say of $500,000, and immediately generate $50,000 a year of income, 10% payout tax-free. It would only be tax-deferred, okay? When you started taking out income, it would be taxable LIFO, like an annuity. If you want tax-free, which is what we're talking about in this episode, you have to comply with TAMRA, okay? Now, if you want to learn more about this, at the end of this episode, I want to gift you a copy of my book that'll explain this in detail. I'm just giving you the bottom line, okay? So for years, I've compared this to, metaphorically, to a bucket. You're creating an account, a bucket, a repository, where you're going to put in your cash contributions and you're going to earn compound interest, but you want that compound interest to be totally tax-free. You determine the amount you want to put into it. That's the premiums that you're putting into it, okay? And so once you determine that, then you comply with TEFRA, DEFRA, and TAMRA, and you take the minimum death benefit required based upon your age, gender, and your health to accommodate the amount of money you want to put in. And so you put in about 20% a year is about as fast as you can do it with indexed universal life. With whole life, the fastest you can do it is over a 7-year period, okay? And so when we do this with an actual example, if I had a 60-year-old male that wanted to put in $500,000 to increase the liquidity of that money, the safety of that money, the rate of return, and have it be totally tax-free, okay, then they're repositioning $500,000 maybe out of their IRAs or 401ks, getting the taxes over and done with and taking the net, put it in here. Maybe they're selling a rental property. They're sick and tired of being the landlord, and they wonder where to put the equity from that rental that they sold into here. Maybe it's money sitting in a bank or credit union, earning a pathetic low rate of return like 3%, and they want to earn more like 9 or 10% tax-free. So they make room for $500,000, let's say. So for a 60-year-old, you could buy a grundle of life insurance for $500,000, millions. That's not the objective. You want the least amount of insurance. And so the least amount now is about $1 million, okay? Now, people say, well, who pays $500,000 for $1 million life insurance? Well, these people do because they're not doing it for that. They're doing it to earn the best rate of return on $500,000 tax-free. They want to self-insure. They want to take on the risk because it's converting this to tax-free, because life insurance is always tax-free, but you have to own the death benefit, okay? And so we comply with TEFRA, DEFRA, and TAMRA. TAMRA says, well, I could put in $250,000 the first year, the first day of the first year if I want, okay? And I have not violated TAMRA. I can put in another $250,000 the first day of the second year. So 1 year and 1 day, 366 days into this, it's 50% full, and it's tax-free. In 2 years and 1 day, I could put in another $125,000 per year in this example. It's up to $250 here, it's up to $375 now. So you could have it 3/4 full. If it was $1 million bucket, you could do that much, that I was saying earlier. And so in 3 years and 1 day, I could actually have my $500,000 in there that fast. You don't have to do it that fast. That's the fastest. Now, once this thing is full with $500,000, it's going to be worth more than $500,000, but let's just keep it simple. Now, you could have that added on top of the death benefit if you die, but now they're going to keep charging you for $1 million of life insurance the rest of your life. And that's going to get more expensive as you get older. You want it to get cheaper as you get older. So you actually can opt to have this $500,000 of cash and the interest you're earning on it, okay, be part of that $1 million death benefit if you die. Well, what does that mean? People say, well, why would I do that? Because you want to self-insure. The $500,000 is now part of the $1 million if you die. They're only going to pay out $1 million when you die. But the insurance company's only charging you, which is the spigot on the bucket. That's the cost of the insurance. That's actually watering the nice little money tree that's going to blossom when you die. They're only going to charge you for the net amount at risk. The difference between this and your money, which is part of that. They're only charging you for half as much life insurance after 4 years, okay? And so it's getting cheaper. You're only paying for half as much life insurance now. The net amount at risk, the difference between your money and that. You can't believe how many agents don't understand this. Now, most of my clients on Index Universal Life have averaged, ever since 1980, when Universal Life was first introduced, they've averaged 9.62%. 9.6 divided into the rule of 72 means your money will double every 7.5 years. So 500,000 will double to $1 million inside here in 7.5 years. So in the 11th year, my cash equals the death benefit. What's the cost of insurance now? What's the net amount at risk now? Zip. I'm self-insured. I now own the death benefit. What was the benefit now? My $1 million is totally tax-free. That was worth it. Now, if at that point in time I have $1 million I could start pulling out 10% a year, $100,000 a year of income, and it would be tax-free forever. Now, if I do it the smart way, if I'm not ready to take income, I wait another 7.5 years, and this million grows to 2 million. Now I could pull out $200,000 a year tax-free. So how do you earn interest on your money that is better than just banks or credit unions? Because this is where banks or credit unions put 30 to 40% of their tier one assets. They borrow your money and pay you 3%. They put it in here and earn 7, 8, 9, or 10%. So let me simplify indexing, okay? Indexing is where if I accumulate, let's say I have $1 million of cash value. We're going to take a snapshot in time. I have $1 million of cash value. Now, if at that point, if I feel bearish about America, I think we're headed for a recession, I can just settle for what is called the general account portfolio interest rate. That's the interest the insurance company is earning on their billions or even trillions of dollars of assets. Some of these insurance companies manage more money than the Internal Revenue Service collects in taxes an entire year. They're humongous, okay? Now, the lowest I've ever been credited is 4%. I've earned as high as 15.5% on the general account portfolio. So let me just take the lowest, 4%. So in 2008, banks were paying less than 1%. Rather than have my money in a bank earning less than 1%, I could have money here, which is where the banks are investing my money. If I put it in a bank, they're investing 30 to 40% of that in an insurance company, earning 4%. Just bypass the middleman. So I can earn 4% tax-free. At the end of that year, I'd have $1,040,000. It's tax-free, okay? Now, I'm acting like I'm not withdrawing money yet. But at any time I feel bullish about America, which 70% of the time, the economy is going to go up. Only 30% does it go down in a given year. So anytime I feel bullish about America, I simply say, don't you dare take $1 of my $1 million and invest it in the stock market, in the S&P 500. You can take the interest on my million, in this example, 40,000. You can take that 40,000. I'm willing to give up the interest on my million, and you can use that however you see fit to have the wherewithal to pay me whatever the S&P does that year. What do they do with the 40,000? This is a no-brainer. They put it in an options budget to buy upside options. They buy them hourly. Then 40,000 of options, easily, if the market goes up 8%, they have 80 grand. They'll pay me 80,000 tax-free. They'll pay me 120,000 if the market goes up 12% on my full million, not on the 40, on the full million. People say, how can they afford to do that? Because it's options. But the protection is this. What if the market tanks? I guessed wrong. The options expire worthless. I didn't earn anything, but I didn't lose. I still have my $1 million. People in 2008 who had their money, $1 million in the S&P, lost 400 grand. It went down to 600,000. People with IUL, they didn't lose a dime. They still had their $1 million. So that's indexing. You make money when the market goes up. You don't lose when the market goes down. You got it? Okay. This is actually explained in the book I want to gift you here in a moment. And it just shows how you take the general account portfolio interest and you give the insurance company permission to use it in an options budget. So they'll have the wherewithal to pay you 8%, 10%, 12%, 16%, whatever, up to a cap. But the trade-off is if the options expire, there's no losses, okay? You still have your $1 million because the remaining 960,000 at the general account portfolio rate grows back up to $1 million, okay? It's really quite simple. Now, here's how it works. When you understand how money works, you'll understand this. An insurance company earning 4% can afford to pay you 8% by doing what I just showed you. because you're getting them off the hook. They're not required to pay you 8% every year because they're only earning 4% on your money. But if you say take the 4% interest and buy options, now they have the wherewithal to pay you 8%. But if the market doesn't go up, they're off the hook. They don't have to pay you 8%. They don't have to pay you anything, but you still have your million. And when you take that pressure off of the company, then the average return will be 8, 9, 10% based on history ever since the Great Depression. So let's say it's 8%. Now, what I just told you, and you can learn more by reading my book, you just understood, hopefully, how an insurance company only earning 4% on their general account, they're actually earning about 5. They need 1 percentage point for them. Okay, they're in business to make money. They keep 1% for them, but they're earning net 4. If that's all they're earning net, they can afford to pay you double that, 8. I just taught you how to do that. You wouldn't believe how many people don't understand that. But let me ask you this. How can that insurance company earning 8 for you afford for you to take out 10% and not deplete principal? Did you understand my question? How can an insurance company allow you to take out 10%? If you have $1 million nest egg, and if it's only earning 8%, you should be able to only pull out $80,000 a year without depleting the $1 million nest egg. How can you pull out $100,000 a year, which is what I'm talking about in this episode, tax-free, without depleting principal? I want to see how. Because you can access money the dumb way. After you recover your basis, the $500,000 you put in there, now you have to pay tax. That's dumb. The IRS says no. From now on, just borrow from the insurance company the equivalent of your interest. And there's 2 ways to borrow. You can borrow with a zero-cost loan. That means if you borrow $100,000 a year from the insurance company using your $1 million of collateral, they'll charge you 2% interest because in order for it to be tax-free loan, they have to charge you the nominal, minimum statutory interest rate in the Internal Revenue Code. They charge you 2%, but they'll credit you 2% on the $100,000 that collateralize the $100,000 loan. Okay. Now, most of our clients are savvy. They'll use an alternate or index loan. It could be 4 or 5%. That means they charge you. If you borrowed the entire $1 million, not 100,000, you borrowed a whole $1 million out of there. You're not borrowing your money per se. You're borrowing $1 million from the insurance company. They're keeping $1 million, your cash value, as collateral. Okay, but now that $1 million is tax-free. They'll charge you 5%, $50,000, but you don't have to write out a check for that. It's automatically deducted out of what you earn. And if you do that, they'll keep crediting you the index rate. I've averaged at least 10%, okay? 10, how much more is 10 than 5 is 100% more. If all you did was average 2% more, you borrow at 5 and you earn 7, that's 2% higher. If you're connecting the dots, that allows you to pull out 2% more money. Instead of paying out 8%, you can pay out 10%. You can pull out $100,000 a year out of $1 million nest egg, $100,000 a year, because you're taking it out at 5 and you keep earning 7 or higher. Now, if this went over your head and you're going, what? You need to study this or you're going to miss out, because this episode is how to pay zero tax on $100,000 a year of retirement income with no tax, okay? No tax. Even if the insurance company is only earning 8% for you with indexing, and they're only earning 4%. Now, this is amazing, but I just taught you how money works. If you want to learn more, please study my book, The Laser Fund. It's actually 2 books in one. This side is the left brain side with all the charts and graphs and explanations. This is the right brain side, all the stories, okay? And if you want to use your whole brain, you can read both of these books. This is 300 pages. It retails on Amazon for anywhere from $20 up to $60. And if you buy it on Amazon, I thank you. but I'll gift you a copy free, hard copy free. You simply go to laserfund.com or click on the link below. You contribute a nominal amount towards the shipping and handling. I require a little bit of skin in the game, okay? There ain't no such thing as free lunch. But you do that and I'll pay for the book. I'll fire out a hard copy to you via priority mail. And while you're in there claiming that free copy, if you'd like to listen and learn or watch and learn, there's those formats available for your investment. You can also schedule to attend one of our free educational webinars that we teach every week. No cost, no obligation. You can even schedule an appointment to talk to an IUL specialist on how you can implement one of these. There's no cost, there's no obligation, but you must do it right for it to perform like I'm talking about in this episode. But don't miss out on how to pay zero tax on $100,000 a year of retirement income for every $1 million you accumulate in an IUL laser